Well, things are tough around the world. As I said, developed markets, if you look at Europe, things are slow. US, things are not exactly booming. Emerging markets, you have this issue that things are slowing plus the currency. So overall, the world economy is okay, but it's hardly kind of booming. So I think last year the market investors got excited because companies came up with lots of cost cutting. Well, clearly, I think the cost cutting's been done now, so the problem is to grow from here. A lot of companies are finding it pretty tough, and I think, as we've said for a long time, it's difficult to grow if you're reliant on the economy to grow. Your only way to grow is through acquisitions. If you're smart enough to make good ones, you can make bad ones as well. If you've got regulated returns like AusNet or Shopping Centres Australia, where there's some lock-in in terms of revenue growth, if you're taking market share from someone else, so that's really where you've got to look for growth. Growth is not coming because economies anywhere are doing particularly well. And things like AusNet, which have fallen quite a long way on a 6.5% yield, and that's 50% franked. With regulated returns, with the payout ratios at 50% actually, so there's room for some regulatory changes. I don't think you can go too far wrong in this environment. As I said, to me, what all this is pointing to is that things are slow and rates will stay slow for longer, and that growth will be harder to find. So nothing's changed. I just think this correction's just sort of shaken up a few people, that we're not on the cusp of some kind of growth about to surge around the world. In fact, it's the opposite. Things are still very tough in many places of the world. I mean, many people should know that anyway, but I think it's taken a couple of events like the one being devalued, like a couple of an announcement from Venezuela, or a couple of those things, for people to understand that those emerging economies, China, which was often the engine of many companies' growth, that there's a question mark over those going forward. What we did last week was we've got the stocks we want to buy, we know the ones we want to buy, and we've basically got them at different prices, at 50 cent or whatever intervals, 20 cent intervals, because I've seen days where like October 87 and the GFC, where things can drop very quickly, and unless you know what PE certain stocks and yield are at certain prices, it's often in the noise, the panic and the confusion, you just lose sight of what the yields or PEs on things are. So we've got our list of where we want to buy things at what yield, and when they hit those levels, we start chipping away. We didn't see many of them hit them, by the way, last week, so we're still waiting. It's impossible to know, right? It's impossible to know. What I do know, in 2 or 3 months it won't be like this. Things will settle down eventually, right? So this is not the norm. Markets moving 5 or 10% every couple of days is not the norm. So I think it's to try and, it will stay volatile in the short term because there are these uncertainties, but within 2 or 3 months things should settle down. At what level, I'm not sure. But the key is, as I said, if you can buy the stocks you like at the right price, on the right yield, then you can hopefully sit through the volatility.